Hi everyone, Sean with Shertzer Bookkeeping here. Ready for another tax series video? Well, you came to the right spot. So today we're going to talk about the Schedule A. Last week I talked about property taxes and mortgage interest. So just to recap, where those would go on the 1040 is down here. This is the 1040 return, individual tax return. Where those will go on this form, this is kind of the summary form. This would be the standard deduction or itemized deductions from Schedule A. Well, what is Schedule A? We'll get to that in a moment. First of all, I want to say what the standard deduction is versus itemized deductions. So, the IRS gives every taxpayer a certain amount to deduct from their gross income. So in previous weeks, I showed you different income sources, common income sources, which would be your total income, which is right here. And then any adjustments to that income, for example, if you had IRA contributions, or educator expenses, that would be adjusted right here, which then would go to your adjusted gross income. You've probably heard a lot of times, most tax preparers, IRS, everyone's going to talk about your AGI. Well, that's what your AGI is your total income with the total adjustments that you get to take off that top line income. Once you get to your adjusted gross income number, you're going to subtract either the standard deduction or itemized deductions. So, standard deduction, those are over here on the left hand side, standard deduction for these filing statuses. So we've got, if you are filing single or you're married filing separately, you get a standard deduction of $14,600. So off of your adjusted gross income, you're going to take off $14,600 right off the bat. Okay. If you are married filing jointly or you are qualifying surviving spouse, then you would get a deduction of $29,200. Which is, yes, double the single standard deduction. So, tax-wise, it can be beneficial to be married. Not going there, that is not my forte. But, yes, it is double the single standard deduction. And then we've got head of household. Head of household is $21,900. So if you qualify as head of household, which we will cover in a future video, you get a standard deduction of $21,900. So, now, what if you have deductions that exceed those amounts? Well, then that's when you would itemize your deductions with Schedule A. So, what is Schedule A? Schedule A is this thing right here. The first thing is going to be medical and dental expenses. So the IRS allows you to deduct medical and dental expenses once you've reached a certain threshold. So first of all, what are the medical and dental expenses you can deduct? Well, let's come over here to the IRS website, type in medical expenses, and see what comes up. So we've got topic number 502, medical and dental expenses. So let's look here. So you can read this, but basically doctor's visits, any doctor's visits, hospital care, nursing home care, acupuncture treatments, inpatient treatment for alcohol or drug addiction, a weight loss program for certain diseases, but you have to be diagnosed by a physician. A health club in some cases. Prescription drugs. If you have if there's a medical conference, like you're part of a test group, that can be deducted. Eyeglasses, contact lenses, hearing aids, medical assist devices, basically. And then basically the medical miles you drive. So if you drive to the hospital or you drive to your doctor's office, those miles can be deducted. And any long-term care. And if they're related to nutrition, wellness, general health, basically like over-the-counter, a lot of that is over-the-counter medications can be deducted as well. So what the suggestion is add up all of your medical expenses that qualify, find out what that is, put that number in there, and then what your AGI is from the 1040. And you have to multiply your AGI by 7.5%. That is the amount that it has to be able to get any medical deduction. So if you do spend a lot on medical, prescription drugs, doctor's visits, that kind of thing, it is beneficial to add all of your medical expenses and deduct. Moving on. Taxes you paid. State and local income taxes, that will generally be, as long as you're using a tax software, this will automatically populate based on other numbers you put into it. The biggest thing here is real estate taxes, like we covered last video, and also your personal property taxes. Again, that depends on the state. Here in California, that would be your vehicle license fee. That's basically a certain part of your registration. On your registration form or your receipt, you'll see where it says vehicle license fee. That's part of the registration amount you paid. So let's say you paid $300 for your registration for the year. Maybe only $20 or $25 of it is your vehicle license fee that you would be able to deduct here on your taxes. Okay. So add up all of these numbers and put it right here. So it's either going to be however much you did pay up to $10,000. So it's either the smaller of all of that added up or $10,000. So $10,000 is the maximum in this section. If you have $10,000 worth of property tax or real estate taxes, that's what you're going to deduct is $10,000 from this for this section alone. Next, we've got interest you paid. So basically mortgage interest. You own a home, you pay your mortgage payment every month. The interest portion of that payment is deductible on taxes. So you would list them here, and that whatever amount you paid in interest, not the principal, the interest, that you get to deduct the interest portion. Let's say your house payment is $2,500. Let's say $2,000 is going to the interest because you just bought your home. Interest is usually front loaded. Let's say it's $2,000 for that month for your interest payment or your interest. $500 is going to the principal. You get to deduct $2,000 out of that payment. So times it by 12, that's $24,000 you would get to deduct on your taxes. Next thing, gifts to charity. If you donate cash to, let's say, for example, Goodwill, let's say the local public broadcast station, here it's called PBS in California, or in the Sacramento area at least. You donate to your church. You tithe if you're Christian. Basically, or whatever religion you are, if you give to your church, you can theoretically deduct that money. If you donate clothing to Goodwill or Salvation Army, if you donate whatever stuff that you have that you want to get rid of, donate it to a charitable organization. In most cases, you would get to deduct the fair market value of those items. So that you would put that here in this line. Now, casualty and theft losses, that's generally, if it's from a federally declared disaster, meaning the president would have to declare a federal emergency, you would get to deduct that loss. So all of that added up, then you would add all of that up, you would put that on this line. So let's say you're married filing jointly, and this comes out to $35,000. Married filing jointly, your standard deduction is $29,200. So you would get to deduct more. You would get to deduct $35,000 instead of the $29,200. So it's beneficial to keep all of those receipts, all of that documentation to be able to deduct on your taxes. What if you don't have receipts? As long as you have some sort of documentation, it's a good idea to deduct that from your taxes. Just remember, if the IRS comes knocking, then you would have to substantiate what you put on your taxes. So just a little word of warning there. Just make sure you have proof of whatever you deduct. Okay, now you might be asking, hey Sean, I'm married filing jointly, but I only have $20,000 worth of deductions. I went through Schedule A, I only have $20,000. Well, then it depends on what you want to do. You do technically have the option to itemize your deductions still and only get $20,000, or you can take the standard deduction, which most people would do in that case, for $29,200. There are some cases where you have to itemize deductions, but that would depend on your specific situation. Speaking in general terms here, it's almost always a good idea, 99% of the time, to take the standard deduction if it's higher. Whatever amount gives you the highest deduction, that's what you want to do, generally speaking. So, I hope that helps. So, if you take anything out of today, keep all your receipts or keep records of any possible deductions. When it comes to tax time like we're in now, make sure you have those when you're doing your taxes, or hand them over to your tax preparer. Again, if it becomes too much, feel free to reach out to me. I do prepare taxes, and I'd love to talk to you about the best way we can go about getting your taxes filed and paying the minimum amount that you need to pay. If you have any questions, feel free to drop a comment on this video or reach out to me on the phone number coming up in just a second. Thank you, everyone. Have a great day.